Let's talk about lines of credit, who can get them, and what types are available. But first, I think we need to define what is a line of credit. Well, see, a line of credit is simply a preset borrowing limit that can be tapped into at any time. So the borrower can basically take the money out as needed until the limit is reached. The money is repaid, and as it's repaid, the borrower can then pull it out and borrow it again. This is called an open line of credit. So what types of lines of credit are available? Well, let's discuss that. So the different types of lines of credit are, number one, business line of credit. Number two, you have a personal line of credit. So you might ask, how does a business line of credit work? Well, a bank or a lender is going to approve you for a set amount of financing, otherwise known as a credit limit, which you can draw from at any time. Now, once you've repaid what you've spent, you can continue to draw capital from your line of credit, assuming that it's an open line of credit. This sort of financing is often referred to as revolving credit because you can tap into it again and again. Here's an example. Say that you got approved for a small business line of credit for $80,000. You decide to take $40,000 and keep the other $40,000 in the pool. So once you pay back the 40 grand that you originally borrowed and the interest, you'll now have the $80,000 again at your fingertips without even having to apply for another loan. Now, revolving small lines of credit typically don't have term lengths, so you can withdraw and pay back those funds indefinitely, or as long as your lender believes that you're a responsible borrower. So keep in mind, the lender can lower your credit limit at their sole discretion anytime. The time and energy that you save is one of the biggest benefits to a business line of credit. Believe me, I know as a small business owner, we need to have time to do our business instead of time to focus on this kind of stuff. Some non-revolving lenders will have you repay and renew your line of credit, assuming you've remained in good graces with the lender. Reapplying should be a really easy process since you already have a relationship with them. Business lines of credit are sometimes differentiated as short-term lines of credit and medium-term lines of credit. The differences are mostly their minimum qualifications, the maximum amount of funds, and of course the interest rate. The longest term lines of credit typically come from an FDIC type of a bank, Bank of America, Wells Fargo. Well, medium-term credit and short-term credit comes from like your online lenders. Business lines can come as secured or unsecured. They can be secured with collateral of your inventory or accounts receivable, or they can be unsecured with just your personal guarantee. Now, number two, personal lines of credit. A personal line of credit is a set amount of money that which you can borrow from up to the limit again for a certain amount of time, referred to as your draw period. Now, similar to a credit card, you can draw the amount that you need from the available balance, and you'll only pay interest on the amount that you've drawn. A personal line of credit is a revolving line. Okay, so you might ask,
how does a personal line of credit work exactly?
Well, with the personal line of credit, you can access your available balance of funds at any time during the draw period up to the limit. You can draw funds over time or as you need them. Any repaid funds during your draw period will refill the available balance, assuming that the lender didn't close the line or lower your limit. Now, with a personal line of credit, you get to choose when to take advances. Now, this is much different than a term loan where you receive a lump sum at the beginning and then you have to start paying interest immediately on all of the money. You'll also have the option to only pay interest on the amount that you've drawn. Now, how can you use a personal line of credit, you might ask? Well, whether you need this for refinancing like eligible debt or it's required for a significant amount of cash up front, a personal line of credit can definitely help. Now, there are many ways to use this line of credit, like refinancing student loan debt, auto loans. It can also provide access to credit for large expenses, like healthcare expenses that you weren't expecting, or volleyball for the kids, maybe football if you've got a boy. Now, what is a home equity line of credit? Well, a home equity line of credit, also known as a HELOC, is a second mortgage that gives you access to cash based on the value of your home. You can draw from the home equity line of credit and repay all of it or some of it monthly, just like a credit card. With a HELOC, you could borrow against your home's equity, in which the home's value, minus of course the amount that you owe. Now, you can also get a HELOC if you don't have a mortgage, if you own the house outright. In that case, the HELOC would serve as your first primary mortgage. Now, when you're shopping around for a loan, borrowing from the equity of your home will oftentimes get you a better interest rate because the risk to the lender is much less since he can take your property away as collateral. Let's go over the takeaways for the personal line of credit. Number one, you typically have a 10 years to withdraw cash from the home equity line of credit while paying back interest, and then they take another 20 years to have you pay back interest plus principal. Unlike most loans, your interest rate may be based on market conditions. So as the Fed hikes rates, your interest rate could go up, just like a credit card. And also, point number three, in order to qualify for a home equity line of credit, lenders will typically use your credit score over 620 and a debt to income ratio that's less than 40%. And of course, they don't want you to take more than 85%, maybe 90% of the home's total value to have loans or collateral against it. Since you risk losing your home if you can't repay the loan, a home equity line of credit is best reserved for expenses that will help build wealth, like home improvements, renovations, and those who want to bolster their emergency funds. A HELOC is not an appropriate way to finance vacations or depreciating assets like cars or boats. It's just not a great fit for somebody who plans to sell their home in the very near future, unless you were getting that home equity line of credit to do repairs on your home. That way you could sell it for more money. Now, if you'd like to get any information on these lines of credit, I'll go ahead and post a link down here in the description, along with an email from one of my preferred lenders that you can talk to. If you're in Arizona or California, anywhere else, go ahead and shoot us an email and we'll go ahead and get back to you with an answer and maybe hook you up with somebody in your state. All right, guys, well, thanks for tuning in. Until next time, I'll talk to you later.